Podcast is now starting. All attendees are in listen-only mode.
Okay, so hello and welcome today. This is our webinar on tax-efficient profit extraction from your Gunner business. So I hope you find this interesting and get something useful out of it. So my name's Liam White. I'm the Associate Director at Capstone Financial Management. We've been helping partners within Gunner now for over the best part of 18 months, helping them build sort of their financial plans for their future. One of the points that always does come up is being tax efficient. The majority of partners will work and operate through limited companies, and there are a number of ways that you can kind of take advantage of that and actually very legitimately help save yourself some tax along the way as well. And hopefully throughout today's presentation you'll get a few points and a few tips. So, profit extraction. So hopefully everyone's kind of logged on here because they really want to get something interesting. But what I will do is I will guarantee by the end of the 30 minutes, you will probably, more than likely, get something out of this. Maybe it's 1 or 2 points that you can potentially change to your own sort of financial planning, or if it's something you're looking to build in over the course of the next year, you should be able to take something away that will allow you to invest in a much better way, but in an also much more tax efficient manner as well. So when we talk about tax efficient investing, okay, there are a number of ways you can save your money in a very tax efficient manner. So those are ISAs, which the majority of us will have heard of, pensions, venture capital trusts, and also enterprise investment schemes. So for today, I will actually be mostly discussing around pensions and venture capital trust, purely for the reason, if you look at the top of the columns, you get income tax relief on money that goes into them. And this is one of the key points to actually helping reduce any tax liabilities that you receive. ISAs definitely have a place in investing purely because the growth on your investments will be free of tax and will give really good tax-free returns for you in the future. I would say on that point, if you are in a position when you've built up cash ISAs, they're not quite as tax efficient as they were, purely because all savings interest is now free of income tax up to certain levels. We've all got a savings allowance, which is £1,000 for a basic rate taxpayer and £500. Venture capital trust, very much part of today's conversation. Enterprise investment scheme, or EIS as it says there, very much part of the financial planning we help our clients with, more around inheritance tax planning, and also for clients who are looking to try and defer any capital gains. Okay, so how do we take money out of our business? So in a very simple manner, there are generally 3 ways. So we can pay ourselves a salary. So this is assuming you're working through a limited company. And I would imagine the majority of you will be paying a fairly low level of salary, up to the lower level that you need to pay in salary to entitle you to benefits such as state pensions, etc. You do pay income tax and national insurance on salary, which is why you will be paying yourself more than likely a low level of salary. Dividends, when you work through a limited company, are probably the most tax efficient way to actually put money in your pocket, because they're different tax rates to income tax rates. Okay, so we all have a dividend allowance. So the first £2,000 that we take out of our company by a dividend each year is actually free of tax. But then depending on the rate of the tax that you pay will depend on the dividend tax that you'll be paying on that as well. So so we've got a basic rate threshold. Okay, and this year from April it was actually increased to £50,000. So if you're in a position where you take up to £50,000 out of your business, after the first £2,000 of tax-free dividend, you'll only actually be paying 7.5% income tax on that, which is actually really low when you consider that basic rate income tax is 20%. So you'll only be paying 7.5%. So I'd encourage everybody, if they're in a position to do that, take up to £50,000 out of the business because you'll be paying tax at a very low rate. Once we go over £50,000, we become a higher rate taxpayer. Okay, so dividend tax at a higher rate is 32.5%, which is a key figure for later on, so we'll remind ourselves of that. When you become an additional rate taxpayer, i.e. you've taken more than £150,000 out of your business throughout the course of the tax year, you will become an additional rate taxpayer. Okay, dividend tax at that level is 38.1%. Okay, so we're taking salary out of our business at a lower level and dividends. The other way you can remunerate yourself as a business owner is via pension contributions. Hands down, this is the most tax efficient way you can take money out of your business. You don't pay any income tax, purely because the money goes directly from your business into your pension, as long as you're doing it in the correct way. And also, it'll be classed as a business expense. So any money paid into the pension is a legitimate business expense, and we'll come on to that and how that actually benefits yourselves and reduces your tax going forward as well. So when we talk about profit extraction, okay, it's not a one size fits all, because everybody will have a completely different situation. All clients will need to take different levels of income out of their business. Different clients will have different points in time when they'll actually need money. So although pensions are really tax efficient and more tax efficient than anything else, the money is away till you're 55 at the earliest. Okay, so actually understanding what your wider financial plans are and what your goals are, we can then start to really devise the most tax efficient plan for you to take money out of your business that will actually meet your own personal goals going forward. Now, pension contributions. So employer versus personal pension contributions. So a personal pension contribution is effectively when you've taken money out of the business and you've paid all of your tax on it. So it's in your own name and it's in the savings account. If you then had that money and put it back into a pension, it's a personal contribution and you would receive tax relief. However, because you're working through a company, you've got the ability to make an employer contribution. So your company will make that pension payment for you. Again, the most tax efficient way to do so, because any pension contribution will attract corporation tax savings. It's an automatic reduction in profit of the business. So, for example, if you were to pay £10,000 into a pension in one tax year, you will reduce your company profits by £10,000 in that year. Okay, corporation tax is currently 19%, so you would receive, your income, so your corporation tax bill will be £1,900 less than it would be if you hadn't made that pension contribution. So no income tax, and you also get corporation tax. Okay, now working with many kind of partners as we do, and purely because of the way a lot of partners operate and cash flow can be fairly irregular, what can be a good idea is to set your pension up, and whether it's with ourselves or with another company. Okay, think about what's an affordable level of money to pay every month, because paying every month into a pension is a really good thing to do, because you will take advantage of the ups and downs in the market. Set that at a really affordable level. Then when you get to the end of your company year, so not the tax year, your company year, have your annual review at that point. Now, if you're in a position that you've built up profits in your business before the end of your company year, so if your company year end is the 31st of December, as long as money is out of your business account by the end of December, then that is a payment into the pension for that company year and it will reflect in the next year's accounts. So that's just generally from experience the way a lot of partners do work, and it's good financial planning. Okay, annual allowance. So in terms of how much you can pay into a pension, there are minimums and there are maximums. Okay, so in simple terms, your annual allowance is £40,000. So each year you can pay up to £40,000 into a pension, and it has actually been the same for the previous 3 tax years. Okay, so if you'd not actually made any payments over the last 3 years or this year included, you could pay up to £160,000 into a pension. This is called carry forward, and I just wanted to actually explain how this works, because we do get asked a lot of questions around this. Okay, so we're currently in the 2019-2020 tax year. Okay, so your annual allowance for this year is £40,000. So if you wanted to make a pension payment in this year, firstly, you would use the current year's annual allowance. Okay. Now you can see from the diagram on the screen, we're going back 3 years. So you always go back to the furthest year. So in the furthest year, so 3 years ago, this particular example, the client paid £15,000 into the pension. So they had a remaining £25,000 of allowance that they had not used. The following year, they paid £25,000 in. They've got £15,000 left over. The previous year, they paid £30,000 into the pension. They've got £10,000 of their annual allowance left over. Okay, so in that instance, what we can do is if the client wanted to maximise their annual allowance for this year, it's £40,000. They've also got £50,000 of unused annual allowances from previous years. Okay, so in that scenario, what would happen is you would actually make a pension contribution of 90,000, so extra 40,000 from this year plus the carried forward amount, and that would reduce, if you were in that position, your profit in your business this year of £90,000, and it would reduce your allowance by an awful lot. Sorry, your corporation tax. So I speak on the welcome days when new partners are joining Gunner Cook. Okay, this carry forward is a very valuable tactic to have. Now, clearly, certainly in the early years of kind of your career, working through your own company, you probably won't have these levels of money to put away. However, as long as you have a pension, okay, you've always got the ability to carry forward unused allowances. So the answer is if you don't have a pension, just start one, even at a very, very low level. Then in 4 years' time, if your business has been a lot more profitable at that point, you can then go back and use previous unused allowances. This is an example of the tax savings it can make. So a director of their company, they can contribute £40,000 in this year, plus 120,000 via carry forward from the previous 3 years. They could pay £160,000 in that year into the pension. It would reduce the profit by £160,000. That would provide a corporation tax saving of £30,400 and when they came to file their company accounts. Very, very tax efficient. One thing I did want to make you aware of, because this does come up time and time again, is what's called a tapered annual allowance. Now, when you're a high earner, you actually start to lose your annual allowance. So you can see on this graph, on the table, adjusted income on the left-hand side. So as you start to earn over £150,000, your annual allowance starts to reduce. Okay, so at £150,000 of income, so that's salary and dividend, you can still pay up to 40 grand into a pension. Okay, when your income, so salary and dividend, becomes more than 210,000, your annual allowance, which is the amount of money you can pay into your pension, is reduced to £10,000 a year. Now, the caveat I'd like to make here is an employer pension contribution counts towards your adjusted income. So if you want to retain your full annual allowance, you will need to sort of cap out your income at £110,000. So you've got £110,000 of income. You make an employer pension contribution of £40,000. Okay, that brings your adjusted income to 150. So that's something to be aware of. So if you are paying yourselves those levels of income and you'd like to understand how much you can actually pay into a pension without giving yourself a tax charge, please do pick up the phone or drop me an email, because it's something really to be aware of. You don't want to be unknowingly giving yourself a tax charge. Okay, enterprise investment schemes and venture capital trusts, okay, otherwise known as EIS and VCT. Okay, so we're just going to look at the VCT column here, but what you can see there is income tax relief. So you will get 30% income tax relief on money going into a VCT. Okay. A minimum term it has to be held is 5 years. Okay, i.e. with a pension, you need to keep the money invested till age 55. This is shorter term. Maximum investment per tax year is £200,000. Dividends, so the income that these schemes pay is completely tax-free, and the growth within a VCT is also free of all taxes. So they're very, very tax efficient. So how does that work in real terms? So you will invest into a VCT company. So we use a panel of companies after doing a lot of research into the market to make sure we're using the strongest ones. Okay, you'll buy VCT shares and you'll receive a tax certificate. So for example, if you paid £10,000 into a VCT, you will get 30% income tax relief on that contribution. What that means is your income tax bill that year will be reduced by £3,000. Okay, that money is then invested into companies. So these are different to your standard investments. These are the companies invested within a VCT are small to medium-sized companies, not on listed markets. So the big companies, and you probably recognise a couple of those names there, okay, but they are classed as higher risk. Okay, you'll get tax-free dividends, you'll get 30% income tax relief, and you'll get tax-free growth. So, for an example of the sorts of companies that you'll find in a VCT, Five Guys, well-known burger chain, very, very nice burger, if I must say. Just to give you an idea of the VCT that's in, so when this was bought by the VCT bought into Five Guys. Okay, so the cost of that investment was £1.5 million when they initially invested. The valuation on their holding within the VCT now is actually £4.6 million. So the growth in these small to medium-sized businesses is potentially really, really large. Now, within a VCT, what you will see is there'll probably be around about 40 different companies from different sectors, but they're not listed on recognised stock exchanges. Within a VCT, we would expect a few of those companies to fail, but certainly the majority or a good proportion of them should return a good level of capital growth and also dividends over a period of time. So as a long-term investment, they are a good place to have a look at if you've got the capacity for risk, which is a conversation we'd always have with you. So how can these be used in a profit extraction sense? Okay, so we have a company director currently receiving an income of £50,000. So they're a higher rate taxpayer. So any more income they take out of their business will be taxed at a higher rate of tax. So they've got additional profit that's built up in their company that year, and they'd like to take £50,000 out. Okay, they require a tax efficient way of getting this money out. So how can this be done? By using a VCT. So we've got company profits. So what you could do is you could take an additional £50,000 dividend. Because you're a higher rate taxpayer, you pay 32.5% on that dividend that you paid to yourself. So the net result would be, for the £50,000 dividend, you've actually received just over £35,000 into your bank account after your taxes. As an alternative way, what you could do is you could take £50,000 out as a dividend, and you could pay £48,750 of that into a VCT. Now, because you get tax relief on that of 30%, you will reduce your tax bill that year by £14,625, which you can see there is the same as the tax liability of taking the dividend. Now, as long as that money remains invested for 5 years, because that is the period of time you need to keep the money invested for to keep the tax relief. Okay, so you've taken a £50,000 dividend out. After 5 years, you've got £50,000 in your own pocket after all taxes. So you've managed to get money out of your business without paying any income tax. Okay, how else they can be used? So a different way they can be used is via what we call recycling. Okay, so as I said, a VCT needs to be invested for 5 years. So again, in year one, what we can say is, right, the client, they're going to invest £50,000 into a VCT. In year one, they also receive a reduction in income tax of £15,000 that year, so that's 30% of their investment. In year two, they do exactly the same exercise. They put a further £50,000 into the VCT and again get another £15,000 of income tax relief. Now this client, what they will do is they will do the same each year for 5 years. So over 5 years, they've put £250,000 into a VCT. Now what will happen in the 6th year, they don't need to put any new money in because the one they invested in the first year has matured, it can be reinvested again, and they can get an additional £15,000 of income tax relief. So after 5 years of contributions into this type of investment, you can then start to recycle them, which is a really, really tax efficient strategy to do. What I must say as well is the figures on these slides, so that we wouldn't normally expect people to be investing that level, certainly for the first time that they're investing into VCTs. We see sort of much lower levels of investment, £10,000 to £20,000. You can invest a minimum of £3,000 in some of them, but it's a really sort of interesting tax efficient way of taking money out of the business. This is a HMRC endorsed scheme. Now, what you'll see, this is an example of a page from a self-assessment. You can see subscriptions for venture capital trust and also subscriptions for enterprise investment scheme. So it just works its way through. Now, the reason the tax reliefs are so generous on these plans is purely because this is where the government wants money invested into small to medium-sized businesses. That's where a lot of the growth in the economy is, and that's where a lot of the employment will come from. So it makes perfect sense for the government or the HMRC to award these tax reliefs that people can get. One thing that I did want to say, so this is called relevant life cover. So one of the areas that we managed to negotiate to get a discount on life insurance, because Gunnercook as a company, it's a massive opportunity for a life insurer. So why would they not provide a discount to the partners? So when you're paying your personal life cover, you've got the opportunity to pay that through your business. And I wanted to just kind of work this kind of table through because I think it's really interesting. So if anyone on the line is actually paying for personal life cover at the moment, it can actually be quite expensive, because what you need to do is, for example, an ordinary life policy would cost £1,000 over the course of the year. Okay, so to pay that £1,000 net, what you need to do is firstly take that money out of your business. You've got to pay national insurance on the money, and you've got to pay income tax as well. So if you're a higher rate taxpayer, the total cost of actually paying £1,000 in life insurance would actually cost you closer to £1,962. Okay. If you were to pay that money pay for the life insurance through your business, so your business pays the cover, so you've not had to take the money out, you've not had to pay any tax on that money either. Your business pays for the insurance, but the business also gets corporation tax relief on that. Okay, so the net cost of paying for £1,000 of life cover is actually £810. So you can see, broadly speaking, relevant life cover is approximately half the price of paying life cover personally. So again, we've negotiated with Legal and General that they will beat any price in the market for the partners of Gunnercook. So if anybody wants to speak about that, please do drop me a line. One thing I would say with all of these plans, so if you're using a financial advisor, if you're using myself, it really is important to review. And with any investment that has risk in it, that your attitude to risk will change. Generally the older you get, so it really needs to be reviewed. You need to make sure you're as tax efficient as you potentially can be as well. Okay, so review, at least once a year. So that is everything from my webinar today. That's 25 minutes, so on the money. I hope you've found it interesting, and I hope you've taken one or two points from there that you'll be able to put into your own sort of situations. What I would like to do is give you a phone call over the course of the week, just to get some feedback on the webinar, because we always do really want to strive to improve the content on the webinars, but actually pick up with anybody if there are any areas that they personally wanted to ask any questions about as well. So thank you very much for listening to me. I much appreciate your time, and have a great day. Thank you.